Hi everyone, Adrian Player here, mortgage broker based up in Brisbane. This video is a very simple one. We are going to focus on the one topic. Why is the Australian banking system set up in a way to stop property investors getting big? All the rules changed since 2018, and since rates have gone up to 6 to 7%, a lot of people are feeling the same hurt, and the ones that want to get a big portfolio simply can't anymore. And I'll give you a little bit of context for this post. So what actually happened was we had a client that had what did they have? They've got 15 micro apartments under construction with about half of them finished. All right, they're in a situation where they're getting offered by a mid-tier bank for retention of their deal and the next land that is being purchased. And the lender is going out to that person saying that we understand trusts, we can do trusts, we can do these exclusion letters. And then I've pretty much had to go and educate this client on how the banking system works, why this bank doesn't do anywhere close to what this lender is saying, and why that they're just trying to get you on rate, overpromise you, and then you'll submit, and then 1, 2, 3 weeks of arguing and saying that we're trying to go to this state manager or this manager to get the deal approved, and then suddenly they're not going to be able to get the deal through. All right, so let's talk about the post, and then I'll just talk widely about the issue. So the Australian banking system is designed to stop property investors getting big to hit passive income targets or shorter retirement goals. Here is some of the restrictions they put on people. DTI limits, so debt to income ratio limits, i.e. if the bank borrowing calculator says yes, but the DTI limit is too high, they stop you. Okay, next one, rental reliance rules. If 50% of your income is in rent or more, if yes, they stop you. Even worse, if they don't do trust exclusions, they aggregate all your loans together and cut you off sooner. So if you've got some of these other properties inside of companies or company trusts, they'll group it all together and hit you with the rental reliance rules earlier if you go to the wrong banks. So some banks don't do this. They allow trust exclusions and only work off 50% rental reliance rule off the personal name only. Next one, sophisticated investor rule. Are you over or under 4 properties? Okay, if you're over, we load the interest rate, we decrease the servicing because that is the rate that they put the stress test on top where they check your borrowing power. Or we put so many shadings of income and loadings on expenses that deals servicing drops through the floor. Next one, policy. Do we accept trust exclusions or not? 20 plus other policies that reduce income or rent or load expenses. So many banks do that. They'll use, so I'll give you an example. They'll look at a valuation report and the rental estimate. They'll check your rental appraisal, and then they'll use the lower of the two unless there is a fixed lease in place. So that's just one example. Some banks shade rent at 80%, some use all of the rent but higher property expenses, some shade it at 70%. All right, so these are the kind of things. And other banks, they'll cap your rent at a maximum like 6%. Some banks do that. All right, next one. Bank deal appetite. So we do or we don't exclude trusts or trust exclusions, but we don't have a commercial banking arm or a second level assessor with a higher delegated lending authority. So either way, you are shit out of luck. So many banks say yes, but then they send them a few deals, then they review things and shut it down, or they only want the easier portfolios of 1, 2, or 3 client portfolios. Next one, BDMs. Answer me on the above. So go through the questions above, and then pretty please. Most don't know. Half of the lenders say yes, but they don't know. So that's what happened today with this client. They were trying to get poached by a mid-tier bank that kept on saying, look at this great rate, we can do that, great. But in the background, they didn't know that this client had probably 15 other obligations with micro apartments, with company trusts, with companies. And we just flat out told them, you're going to be overpromised, they're going to lodge to that bank, and then they're going to try and do something with a credit assessor or a estate manager approval. But in reality, we already called that bank's BDM. They said they don't have that policy. And if they did, they would only want 1, 2, or 3 properties in a portfolio. And then I asked them, do you have anyone that you've seen in your 17 years in the bank as a BDM for that one bank only that you've seen with 15 different entities with micro apartments, commercial and resi? And the answer was a flat out no. All right, so even if these banks have the policy, right, it's got nothing to do with their deal appetite. So a lot of these banks that don't have the commercial arm or the second level higher delegation authority for the risk level of the sign-offs, you know, even if they've got the policy, they don't want the bigger portfolios anyway. So you can only run the first couple of deals there. Then you've got to go to the main banks that we run these kind of exclusions with. Okay, then the next one, the system is designed against you, and sadly many overpromise and underdeliver in this space. So we do this day in, day out. All right, quick, easy post, and that gives you a very good understanding on how the banking system works and why it's set up for you not to be able to build a large portfolio. Throw on top of that 13 rate increases, and we wonder how we got here.